Jerome Powell just signalled that the Federal Reserve is ready to begin a rate cut cycle in September, something that could not only have catastrophic consequences for inflation, but would also trigger another key recession indicator that has accurately signalled the beginning of all major economic crisis periods and recessions throughout history. This includes the last three major recessions of the 2000s dot-com bubble recession, the global financial crisis in 2008, as well as the pandemic crash, which all saw a recession kick in a matter of months after the rate cut cycle began. Right now we are on the brink of the same historic pattern playing out when a rate cut cycle begins. The fact of the matter is that because a lot of key economic data is lagging so far behind what is actually happening today, the Federal Reserve is almost always too late to start cutting rates, meaning that a recession is often unavoidable when they start to do so. Now, in this speech, Jerome Powell said, "With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance." He added that the labour market faces increasing downside risks and that risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. Now, there are indeed a number of recent signals that the labour market is deteriorating quickly, with unemployment ticking upwards, layoffs ramping up, and new jobs numbers coming in massively below expectations. And perhaps the most concerning signal of all is the scale at which previous months' new jobs numbers are getting revised down, with the numbers for May and June getting revised down by more than 250,000, truly unprecedented levels. And the scale of these recent revisions puts us on par with past recessions and now paints a scarily similar pattern to in 2008 and 2009 at the peak of the global financial crisis. Now, Powell did add that this slowdown is much larger than assessed just a month ago, warning that if these downside risks materialise, they can do so quickly in the form of sharply higher layoffs and rising unemployment. But the problem is that rate cuts are going to take a while to kick in and really start to impact things in a positive way across the labour market and general economy. While the recent negative data Powell is referencing that may have swung his decision to cut rates in September is taken from the state that the economy was in many months ago. And this large gap leaves a lot of time for things to get even worse before a reactionary decision is made by the Fed, rather than a preventative one, meaning that rate cuts are likely already too late and may not prevent an imminent recession or something even worse for the economy. Lower interest rates will of course increase the levels of borrowing, investment and spending in the economy, all of which is going to put more upwards pressure on inflation, which has been ramping up in recent months. The price of goods has already been surging in 2025, largely due to the tariff price pressure for producers and importers, as well as the dollar's sizable depreciation. And the service sector is set for inflation pressure too, looking at this chart showing the strong correlation between CPI lagged by 3 months and the ISM Services Prices Paid Index. Now, this index has been surging upwards in recent months, which is not a good sign as it does suggest that CPI will soon follow. And Walmart, the world's largest retailer, warned this week that levies were beginning to push up its costs as it cycles through inventory that was purchased before they were put into place, a clear warning of a potential future rise in inflation. We've even just seen red-hot producer price index numbers come in for the month of July, accelerating by 0.9% compared to the previous month, the largest increase for 3 years, and now puts the year-on-year index change up to 3.3%. And all of this does suggest that US companies are indeed passing along higher import costs related to tariffs to the consumers. A senior economist at Nationwide has also warned that we will probably see this behaviour continue and even get worse in the future, saying, "Margins are being increasingly squeezed by higher costs for imported goods. We expect a stronger pass-through of levies into consumer prices in coming months, with inflation likely to climb modestly over the second half of 2025. It's clear now that the Federal Reserve is backed into a corner of stagflation being the only option, where they will need to cut rates and let inflation run hot in order to stimulate the declining jobs market and broader economy. In other words, this means that the money printer is back on, with the money supply set to rise at an even faster pace once rates fall. Now, the last time that we saw rate cuts and rapid money supply expansion was 5 years ago in 2020, leading to a major wave of inflation, and the signs are now there that we could well end up seeing a second wave soon. We are now in an eerily similar economic situation to what happened in the 1970s, when we saw CPI surge in an initial wave, then drop back down to more normal levels, before surging once again in a second inflationary wave to even higher highs. But it's not just the prices of goods, services and everyday bills that could surge, as the last time that we saw rate cuts and money supply expansion, we also saw massive asset price inflation, where the prices of real hard assets like stocks, real estate, gold and crypto all became massively inflated too, thanks to the amount of money sloshing about in the system. And this is another reason why a rate cut cycle beginning right now is so insane, given that the prices of assets are already at all-time highs, and to give them another big pump of liquidity while valuations are so high does seem insane. How much higher can asset prices realistically go from where they are right now? The forward PE ratio of the S&P 500 is at one of the highest points ever in history, far above historic averages. And house prices are also at pretty much all-time highs and have never been so unaffordable in terms of how much the average mortgage does cost for an average price home and how much this is relative to the average household's monthly income. We are therefore looking at an escalating situation where the rich get richer and the poor get poorer, meaning that we are rapidly heading towards a society where there's no middle class, it's just the haves and the have-nots. Those who own lots of assets could end up seeing a huge increase in the price of these assets and the value of their net worth, while poor and working class people who own few assets or none at all are stuck further and further away from owning anything, while paying higher and higher prices for food, bills and rent. Rate cuts also means that the Federal Reserve has likely given in to currency debasement, where they rapidly devalue the US dollar in order to prop up the markets and save the government from their debt crisis, something that will come at a severe cost elsewhere though. The US dollar has already been devalued substantially so far in 2025, and rapid rate cuts over the next year or so would likely see this decline continue. But the US government is stuck in a debt spiral right now, where the debt pile and average interest rate of their debt are both surging, meaning that the annual interest payments on this debt are becoming out of control and unsustainable, now above $1.2 trillion every year. And Bank of America research are projecting annual interest payments to increase to $1.4 trillion in 2026 if interest rates stay steady. The bad news is that there is a gigantic maturity wall of debt that needs to be refinanced in the remainder of 2025 as well as over the next few years, so lower interest rates will massively help the government to keep these surging interest payments down. Now, this research does suggest that the yield on a 5-year US Treasury would need to fall to 3.1% to keep interest payments stable, implying 75 basis points worth of rate cuts to keep payments where they are at these already astronomical levels. The rate cuts devaluing the dollar further also helps the government to essentially inflate away the debt pile, another thing that helps them to try and escape from this debt crisis. Now, this pace of dollar devaluation has even been increasing in recent years anyway, and you can see on this chart that the US dollar has lost 40% of its purchasing power since the year 2000, but a large portion of this decline has come since 2020. $37 trillion in debt today is going to be worth less than $37 trillion next year or in 5 years' time, and although the debt pile is going to keep going up, if dollar devaluation and inflation outpaces the overall government debt pile, then in real terms their debt pile will shrink over time. Now, all of this may well help the government to manage themselves out of their debt addiction, but of course this comes at the cost to the everyday American consumer, as we have already discussed, who will see their cost of living surge, and assets become harder and harder to obtain in a stagflation environment. The housing market is one area of the economy that is not in a healthy state at all right now, especially with the growing imbalance between buyers and sellers. And home builders are now starting to panic, desperately trying to offload their growing inventories into an already weakening market, something that could potentially trigger a crash similar to in 2008. Now, I covered this topic in more detail in my previous video. You can check it out by clicking on screen right now. Aside from that, if you enjoyed this video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.